Bienvenido a un nuevo evento de Cátedra Europa.
Good morning. On behalf of the 24th edition of Cátedra Europa, we welcome you to the lecture Fair Value, Earning Management, and Asset Impairment, the Impact of a Change in the Regulatory Environment, for which we have the special participation of Dr. Richard Andrews from Hull University. We will now leave you with Professor Yuli Gomez, who will be moderating the session. Welcome. Professor, we can hear you.
Oh, I'm sorry about that. Thank you, Maria Gabriela. Good morning, everyone. Welcome to Cátedra Europa. Thank you, Dr. Andrews, for accepting our invitation to join our conversation with a conference titled Fair Value Earnings Management and Asset Impairment. Dr. Richard Andrews is a lecturer in accounting at University of Hull Business School, and he currently holds the position of Programming Director at the Master of Science Professional Accounting. Dr. Andrews has a bachelor's in accounting, a master's degree in finances, and a PhD in impairment of assets. He's also a member and fellow of the Association of Chartered Certified Accountants, ACCA. Thank you once again for your valuable intervention, Dr. Andrews. Without further ado, I give way to our guest. Welcome, Dr. Richard.
Okay, thanks very much, Yuli. Thank you for that introduction. That was very nice. So, yes, so I'll start sharing my presentation with you now, and I may well just pause my camera just to give it a bit more bandwidth. Let me just try that. So if I bring up the screen share, now we tried this earlier on, and it didn't quite work. So I think if I leave it at that, hopefully you can see that. But I think if I go onto the full screen, you maybe can't see it. So I think I'll just try that one more time, and maybe you can tell me if you can see it or not. If I go onto the full screen, are you able to see that? The full screen PowerPoint or not? Okay, well, maybe not, then I can't hear anything there.
Yes, Dr. Richard, we can see your screen.
Oh, good. So could you see the full PowerPoint there?
It's not as a full PowerPoint slide, but we can see the presentation. So I
okay,
believe
so I'll carry on as that then. Okay, so welcome to this presentation, and thanks very much for attending. As you can see, the title is Asset Impairment and a Change in the Regulatory Environment, and this relates to the case of International Accounting Standard 36 and its adoption in the UK. And it's quite significant because of the fact that when we switched over to IAS 36 in the UK, just as a little bit of background, this resulted in the arbitrary, well, prior to the regulation, it was the arbitrary amortization of goodwill over an arbitrary number of years. And since the change came in for IAS 36, what it meant was that companies didn't have to arbitrarily depreciate or amortize goodwill. So that was the sort of the research problem, if you like. And this had been studied in the US quite a bit when they had a similar change in relating to the Financial Accounting Standards Board in the US. And I thought it would be quite a good area to look at in terms of my PhD. So it was part of my PhD, which involves several other factors as well. But the bit that I'm going to look at on this particular presentation is specifically looking at the extent of earnings management, and in particular whether a change in the regulatory environment encouraged more or less in terms of earnings management. So that was the critical question, if you like. And also, as you'll see, when the presentation progresses, the issue of fair value is quite a contentious one, because IAS 36 looks at bringing in different levels when it comes to fair value. So level 1 is the actual market. Level 2 is an equivalent market, but the most subjective area of fair value is that relating to the use of, for example, discounted future values or value to the business. And this is where it becomes very subjective. And in particular, when we're looking at goodwill and asset impairment, then what it means is that quite often the decision to make an asset impairment is on the basis of estimating the discounted future cash flows. And so that becomes very subjective. So that's the bit of background there. The methodology that I've used is a quantitative and qualitative methodology. And so we'll have a look at the results and also the conclusion. So that's the overview of the paper. There's a lot of literature around earnings management, but the overall theoretical context of this is, one aspect of it is agency theory. So is the management acting in the best interest of the shareholders of the company, or are they acting in some sort of self-serving, opportunistic interest? And that was the basis of what agency theory was all about, developed by Watson Zimmerman in the late 1970s. So typically, if we're looking at earnings management, some managers may well decide to manipulate the profit for their own personal gain. And this has been proven over the years through things like bonus schemes. When a manager is on performance-related pay, they may well get a bonus based on profit, and then it would be in their interest to manipulate that profit figure, just as an example. Then also within the background of this work is the notion of conservatism within corporate reporting. And the background to conservatism, some might say it's a principle. You could also say it's a theory, but over time, looking at it from a normative perspective, conservatism has been the backbone of financial reporting in terms of not being over-optimistic when it comes to reporting revenue, and being cautious and prudent when it comes to estimating losses. So Ball and Shivakumar developed this idea of conditional and unconditional conservatism and the role that this plays within corporate reporting. And if we're looking at conditional conservatism, it relates to the environment within which the company is operating, the economic environment, what are the causes of being conservative within financial reporting. And then on the other side of that is unconditional conservatism, which, if you think about it, relates to the fact that we've got conservatism which is endemic or pervasive as a background within all corporate reporting. So conditional conservatism would be more reacting to conditions. Unconditional would be the case of the regulatory environment prior to the UK adopting IAS 36, and that would be the case of arbitrary amortization of goodwill over its useful life. So it doesn't matter what the conditions are, it would just be arbitrarily depreciated or amortized over its useful life. So again, these two theoretical constructs formed a basis of the work that I was doing here, in terms of, yes, we've got agency theory on the one hand, that's a positive theory. Then we've also got normative theory of conservatism. And you could argue, well, is conservatism a theory or not? You could argue it either way, really. It's a principle of financial reporting. Whether it's a theory is open to debate. So a lot of the literature looks at big baths. So you may or may not know that a big bath relates to the instance of a large write-off. And usually, quite often, this large write-off can be associated with a change of management or some other circumstance that leads the management to decide, right, we'd like to do a large goodwill write-off here in order to make a change to the underlying asset value. And often the asset that gets written off to the greatest extent relates to that of goodwill or intangible assets, and that's quite a phenomenon. The other aspect, which is a bit more difficult to detect, is that of income smoothing. And this is evident within financial reporting as well, and this is in the UK context, because often shareholders have various expectations in terms of what they expect earnings to be, and income smoothing has the effect of maybe bringing earnings up or down to within more expectations of the shareholders. So that's a bit of income smoothing. So it's a little bit more difficult to detect. A big bat is a very large write-off. That's quite easy to detect relatively to income smoothing. And then also the issue of if companies are engaging in earnings management, well, how does this relate to the objectives of corporate reporting? And if we look at the objectives of corporate reporting, it's all to do with enabling users to make a more informed investment decision. If we're looking at it from the shareholder perspective, it's looking at it from the point of view of shareholder returns, dividends, future profits. And what you need to ask yourself is does the process of earnings management, is it in line with the objectives of corporate reporting? Or is it more self-serving from a management perspective? Is it more a case of manipulation, or is it more a case of seeking to show a true and fair view when it comes
Dr.
to the
Andrews,
yes,
excuse me for the interruption. Dr.
yeah,
Andrews, would you be so kind to turn on the cameras? Because I believe that you have it up, and we want to Very, thank you much.
is that good? Can you see me?
Yes, sir, we can see you. Thank
Oh,
you.
that's good. Okay, that's fine. Yeah. Okay, so yeah, so as I was saying, so the change in the regulatory environment and the impact upon corporate reporting practice. So the work that I did looked at the fact that the change in the regulatory environment was the fact that typically companies were no longer required to arbitrarily amortize goodwill in particular, and that led to companies having larger amounts of goodwill on their accounts than what they would otherwise have had. And then also we've got the role of fair value. And as I was saying earlier, when it comes to estimating the value of intangible assets, then often the fair value measurement method used is that of the value to the business. And the value to the business is using a discounted cash flow approach, which while can be quite useful from an information utility perspective, it is very subjective. So those are the things that we're sort of thinking about then. And if we look at IAS 36, you can see the sort of decision criteria that we've got on this particular slide. If you look at this, what we've got is we're looking at the fact that historical cost is the amount that we've often paid for an asset, and then the decision to make an asset impairment review or to write off an item would be the recoverable amount, and the recoverable amount here would be based on the higher of net realizable value. So that would be the market value or value in use. So this value in use figure is often the one that's subjective, particularly when we're looking at intangible assets. So the value in use figure could be projected future discounted cash flows, for example. And we know that in particular, when we're looking at discounted cash flows, these are very difficult to accurately verify, and often they may turn out to be optimistic. They may also turn out to be pessimistic. But the key here is, you can see, if historical cost, if we think the recoverable amount is higher than historical cost, then what we're looking at is doing the higher of either net realizable value, NRV, or value in use. And you can see there's quite a lot of degree of subjectivity here that managers can carry out, because it may well be that they've got a net realizable value that's coming in lower than historical cost, But the value in use figure, particularly if it's a projected future cash flow figure, well then that could come in either higher or lower than net realizable value. It could also come in higher than the historical cost, in which case that would avoid the need for a write-off altogether. So the amount of impairment, the amount that we're going to write off in terms of the asset impairment figure very much depends on how much we calculate, or how much the management calculate in this value in use figure. And that's where the subjectivity comes in. So that's a bit of background to the IAS impairment review decision. And previously to this, under the UK reporting regime, we didn't have this sort of value in use figure, and also we just simply wrote off goodwill arbitrarily at a fixed amount each year. So that was the difference. And if you think about it, goodwill can form millions and millions of pounds when it comes to carrying amounts on corporate balance sheets. So that's why it's a critical issue. So the research questions that I was looking at in relation to this particular part of my PhD, I was looking at, does charging an asset impairment loss result in a greater prevalence of income smoothing or big bath accounting? So we'll look at the results of that in a few moments. And then also we've got, does a change in the regulatory environment relating to asset impairment testing result in an increase of income smoothing or big bath accounting? So two fairly interrelated questions there. Number one, if we're looking at an impairment loss, what's the behavior, income smoothing or big bath accounting? And number two, does this change in the regulatory environment result in greater changes in behavior when it comes to earnings management? And something that I'm not looking at in this presentation, but I also looked at the fact that different companies disclose many different aspects relating to their asset impairment information. But one bit that I do look at in a bit of detail here is the valuation method. So that's sort of the research questions there. And if we look at the sample that I've used, well, I've split the sample to pre the change in the regulation. So the regulations came in sort of the middle of that sample section. So we've got annual reports from 2003 to 2008. So that covers a couple of years before the change in the regulatory environment, and also a couple of years or 3 years after the change in the regulatory environment. And what I looked at was FTSE 100 corporations. So this is the largest listed companies on the UK stock market, the Financial Times Stock Exchange. And I looked at those corporations that were disclosing an impairment loss. So I identified over that time frame 94 corporations disclosing an impairment loss. And out of the 94, many of these companies, 64, reported repeated asset impairment. So it's quite a common theme, is that once a company starts doing asset impairments, then they tend to sort of repeat this behavior. And there could be a whole range of reasons for this. It might be that they've paid too much for an acquisition, for example, and they've decided to write off some of their goodwill and some of the other assets on an acquisition. It could be that the synergies of a takeover have not quite materialized the way that they would have liked to. So a whole range of reasons as to why companies report asset impairment losses. But it's important to realize that this is usually after an acquisition of a subsidiary, and that's what gives rise to the creation, the capitalization of goodwill on the balance sheet. So the methodology that I looked at was use of the expected earnings to identify the characteristic of income smoothing or big bath accounting. And this has been used probably most widely by Rydell. So 2004, so quite a good solid foundation there in terms of previous use. Zucker and Campbell also did a very similar methodology, and also so did Moses, so that it has been used quite a bit. And then Jordan and Clark and Seven and Schroeder also looked at the differences between return on assets and return on sales in order to evaluate the existence of either big bath accounting. So if it's got a large impact on the return on assets and return on sales, it would be considered to be more of a big bath. And if it's got a lesser impact, we'll be looking at do we consider it to be income smoothing? And so that's sort of the background then. If we look at the broad formula that they've used, is I've sort of tweaked it slightly, but these are the ones that particularly Zucker and Campbell used, and I also incorporated a bit of the Moses formula as well. But this is the basic formula, and you can see here we've got the pre-write down earnings. So where the pre-write down earnings are lower than the expected earnings, and the reported earnings are also lower than expected earnings, and we would expect that to be the characteristic of a big bath. So it's not 100%, but that's the general idea. And then similarly, you can see that where the pre-write down earnings are higher than the expected earnings, and also the reported earnings higher than the expected earnings, well, then that will be more in line with what we would call income smoothing. And so that's really what I've sort of based my data on in terms of that sort of formula. And if we have a look at some of the results here, well, you can see this is just looking at the descriptive disclosure in terms of what my findings were. So you can see in terms of property, plant and equipment, I found 62 impairments there. Goodwill and intangibles, others, there was 54 and 31. And then investment, there was 11. So over that period, there was 158 different reported impairments from a total of 94 companies. And as I say, 64 of those companies had repeated asset impairments, so more than one. So that's the characteristic of the data set. And then if we move on, again, just looking at the descriptive evaluation of the asset classification and the valuation method, well, then you can see what quite unsurprisingly, the property, plant and equipment, so tangible assets, most of them were using either recoverable amount or net realizable value, with 18 using the value in use figure. And so a lot more using more objective methods, being recoverable amount and net realizable value for property, plant and equipment, rather than the more subjective value in use, only 18. And then you can see quite the opposite for goodwill. So for goodwill, a lot more use of the subjective value in use valuation method. So 35, looking at using discounted cash flows to try and estimate a value for goodwill. And so we can see the subjectivity of that means that you've got a lot more subjectivity in the determination of that figure, and hence the determination of the asset impairment amount. And these amounts can be really running into tens of millions of pounds for the companies concerned. They can often turn a profit into a loss, for example. They can be really, really large write-offs, which is why I would characterize them as a big bath. So for goodwill, only 7 and 6 were using recoverable amount or net realizable value, and that's probably because goodwill is intangible in nature. It's quite difficult to value, very subjective. And then intangibles, others, again, similar sort of pattern, but not quite as much, because the extent of other intangibles is a bit more restricted, with 16, 7 and 5 there. And then investment, well, that is really just items held for usually it's shareholdings in other companies that can be quite quickly liquidated. So that would have the market there in terms of recoverable amount, the actual value of the market, or the net realizable value. So you can see here the goodwill is not the asset most frequently subject to impairment, but overall intangibles are, if we look at the goodwill and intangibles other, then they are subject to impairment. And we can see that the property, plant and equipment has been valued most frequently with the recoverable amount and the net realizable value. So that's a bit about the data set. So if we bring that into the sort of the different valuation methods, we can see here, after applying the formula, well, then we've got a bit of an indication here of what we might term income smoothing and big bath. So you can see here overall, we've got quite a bit more income smoothing going on than big baths over the period that we're looking at. And you can see that we've got value, net recoverable amount, net realizable value, and value in use as the valuation methods. And this is for all assets, not just goodwill. So it's including the property, plant, and equipment, goodwill, and other intangibles, but not such a big extent of big bath accounting when it comes to those different methods. But it is quite interesting that the companies that have got a lot of repeated impairments also report a different valuation method depending on the type of asset. And so if we break that down into types of assets, well, then what we tend to see is that, as I said on the previous slide, goodwill is the asset that's most frequently being used to using the value in use measurement method, whereas more tangible assets are using recoverable amount and net realizable value. So if we move on to I ran the data through the SPSS software with the formula that I've used, and you can see what I want to do also is sort of split the sample between pre-change in the regulatory environment and post the change in the regulatory environment. And so this gives us some quite interesting and significant results because, as you can see, if we look at the different characteristics here, well, we've identified income smoothing to a much wider extent in terms of the pre-change period, so 2003, 2004. And there was quite a lot more impairments taking place post the change, so 2005 to 2007. But you can see there's quite a switch from income smoothing 78% and 19% for big bath accounting. There's quite a switch to big bath accounting post the change to the conditional conservatism aspect of the asset impairment. And so it's gone from only 19 up to 56%. And so that came out of a significant level as 0.038. So, you know, it is significant, but it's not a huge amount of significance, but it is a significantly different change post the change in the regulation. And there's a few reasons for that. Probably the fact that companies have decided to sort of write off more of the goodwill because they may have had a few years where they weren't writing off as much as they might have done. But the reasons for that, of course, this is all pre the financial crisis, so the data is probably a little bit dated now, but it does give you quite a good idea in terms of the impact that a change in having more flexibility in the regulations had in terms of the earnings behavior and the earnings management. So the interpretation of results is that overall income smoothing is the predominant in the sample, 2003 to 2008. But if we split the sample between pre and post change in the regulation, we do see a shift more to big bath accounting. The explanation for that could be fair value in terms of the fact that we have got abolition of the arbitrary amortization of goodwill, and we've got a lot more flexibility and a lot more subjectivity in terms of the fair value figure that we use. And it's the fair value figure that determines the extent of the impairment charge. So that was just one aspect of the PhD that I did, and I did a lot of other areas, particularly in terms of impairment and business sector. So we found that telecoms and media sectors, for example, are the most commonly quoted companies to have impairments, and given that they have quite a large degree of intangible assets such as goodwill, we may expect that. Also, the indicators of impairment. So companies have to disclose what the reason is for impairment, and in a lot of cases it's market factors, maybe the share price has gone down or market expectations have gone down. But another big indicator of impairment is that of restructuring charges. So we found that restructuring charges are also a big factor, and often when a company takes over another one, it may well engage on a restructuring exercise, a cost-cutting exercise, and so that could also be a reason. And also, there's lots and lots of different disclosures that companies make. So some companies do comply with the statutory requirements, others don't always. They don't always disclose the discount rate that they've used, for example, if they're using value in use, which is what they should do according to IAS 36. And also lots of other aspects in terms of the qualitative aspects of disclosure. So what I looked at was I did a word count in terms of how many words companies mentioned, or how many times they mentioned in their notes relating to asset impairment. And so some had quite high degrees of asset impairment disclosure, and others were very, very limited. So just to summarize then, just on the basis of this sort of sample that I looked at, a change in the regulatory environment does appear to impact the extent of big bath accounting. So we saw that big bath accounting tended to increase. And an interesting question that's often overlooked is, well, you could argue, well, is it manipulation? Are companies being manipulative in their earnings by having a big bath, or are they striving more to align the balance sheet more to what the economic reality is in terms of expectations of the future prospects of the company? So is it more a true and fair view in line with the objectives of the corporate reporting, or do we think it's more manipulation? So it is an open-ended question then. Certainly I found instances of both in that case. And conservatism does still have a role to play within financial reporting, despite the optimism of fair value. So there is a conflict there between conservatism, which tends to be more cautious, prudent, and the role of fair value, particularly when we're looking at discounted future cash flows, which tends to be more optimistic and subjective, as opposed to the objectivity of conservatism. So that was a sort of a quick overview, if you like, of my of one aspect of my PhD. So I'm not quite sure how we've done for time there. Did we? We're just probably, it's about half an hour, isn't it? Just over half an hour. So I mean, did anybody have any questions on that? Okay, well, that's a good question then. Yes. So what is the effect of the IAS 36 in financial statements of a company of utilities like electricity provided by the government? Well, it all depends. You know, if they've got old plant and equipment, for example, an old generator, you know, do they write it off? So it also depends, have they got much in terms of, do they have more tangible assets? So that's probably more straightforward. It's a write-off. If they've got intangible assets such as goodwill, so I'm not sure a government-owned electricity company may not have goodwill. It might not be such an issue. But most of the companies that I was looking at, a lot of these impairments related to goodwill, and so that was more of the subjective one. But certainly, what it means is that if you're looking at the financial statements, what you've got to ask yourself is the book value. So is the book value of a non-current asset, is it overstated? And if it is overstated, in other words, more than what we might think the market value is, if that's the case, then what we need to do is write it off, bring it down to what we think is more of an estimate of either its net realizable value or its value to the business. So that's the key there. Does that answer your question?
Yes, I believe that answers our students' questions. The sense would be more because here in Colombia, probably most of the companies do not hold a lot of goodwill, and
Yes, yeah.
they must be wondering how do we apply all of this to our market, because most of our companies are small. Most of the companies that students at the end apply their knowledge could be medium size, and they do not have goodwill, but they do have long term um, living assets. So how can we apply, or how can we adjust what you have been um, teaching us
Yeah, well, I
in
mean,
this
yeah,
lecture?
well, I mean, do you have who's your mobile? Who's the biggest mobile phone provider in Colombia?
It would be either Claro or Movistar. They are from abroad, but they are administered by local headquarters.
Yeah, yeah. So I mean, you know, because often I get students to look at mobile phone companies, for example, because they can be quite big in any country, and I get them to have a look at their annual reports. So, you know, one company that I looked at was Vodafone, for example. I know it's maybe not in Colombia, but you know, if you look at some of the bigger companies, they often do have some pretty big write-offs. But if you're looking at a smaller company, then the principle is the same. And really, what you're looking at is what's the value of non-current assets on the balance sheet, yeah. And you know, if you go back to that to the if we go back to this slide here, for example, it doesn't really matter if they're intangible or not, but you can see if we look at the decision criteria, the critical bit, as far as IAS 36 is concerned, it doesn't matter whether this is intangible or tangible assets, could be any asset you like. You know, this is the book value here, the historical cost is here, and the critical bit becomes here. So before we had value in use here, we just say, okay, well, if we think, let's just say we paid 100,000 for an asset, and we think it's now worth 10,000 because it's obsolete. We don't use it anymore. You know, or we've got limited usage of it. We just say, okay, well, we'll write it off down to the net realizable value. So that was pre IAS 36. So what we've got now is this extra layer of information here. And what the management could say is, okay, well, we might think the net realizable value is only 10,000, but they could say, well, hang on, in 5 years' time, we think this asset might have gone up in value again. We might have another use for it, and we might say, okay, let's say in the next 5 years, we think it's going to be worth 90,000. So that would be saying, okay, well, in that case, then, if the book value is 100, the net realizable value is only 10, but the value in use is 90. That means instead of writing off 90,000 because it's only worth 10, we'd only have to write off 10,000 because we think it's worth 90. Yeah. So it doesn't really matter what size that the company is. If it's got some non-current assets and it's following international accounting standards, it could still have some subjectivity when it comes to how much it writes off, and whether is that a genuine, true and fair view of the business, or is it more a manipulation?
And what happens with those companies that once IAS 36 came into play, thought that their assets were more valuable than they really are, and then COVID-19 came, and all their um, all their assets are not worth what they were
Well, that's right.
forecasted.
Yes. So I mean, yeah. I mean, I mean, on property, plant, and equipment, you can revalue it upwards, but or downwards. But on intangible assets such as goodwill, you cannot. You can never value them upwards. You can only go down. So only go down from the level at which you acquired them. But you're absolutely right. I mean, things are picking up a bit now in the UK, but certainly, at the height of the pandemic, we had a lot of empty shops, for example, and still a lot of shops are empty. So, or shopping centres, a lot of empty shopping centres. And of course, that means that the value of the retail side of things, the value of the retail properties has collapsed. So they're having to write them off actually because they can't get people to rent them. But that was all. I mean, unfortunately, that was already on the wall before the pandemic because of this huge shift to online shopping and Amazon, for example. So there was a slight decrease in the retail sector in the UK. And now, of course, we've seen a big downward turn. As you say, a lot of shops couldn't survive the fact that they had to be locked down and closed for 8 months or 6 months. So it was, so I don't know what will happen in the future. Again, it's like having a crystal ball. Will things get better or not when it comes to the future? We'll have to wait and see on that. Yes.
Thank you, Dr. Richard. So let me verify. I believe we do not have more questions from the students by now, so you may continue if you do have more of your valuable intervention for us.
Okay. Well, yeah. Well, I mean, if you want to sort of come back and have a look at some of these points, I mean, I suppose the interesting point is what we have a look at here. How much longer have I got? Is it 10 minutes? Maybe is it? When is it due to?
Let me verify, please.
Yeah. Yeah.
Yes, we do have 18 minutes, so we can continue.
Great. Okay. Well, that's fine then. Okay. So let's have a look then. So if we come back to this one here, I mean, if we think about big bath and income smoothing, what I have got is quite a bit of information on this, and I'm just trying to think. I could maybe get some additional slides up, but I won't get some slides up at the moment. But if you have a look at the fact of what a big bath is, I mean, are you familiar with the term big bath in terms of what it entails? Okay, well, I'll show you an example. What I'll do is I'll just stop sharing this slide, and I'll just come on to another slide that I've got to give you an example of a big bath because it is quite interesting. So what I'll do is I'll just bring one up for you that you can have a look at.
Yes, it would be very valuable,
see
Dr. Richard,
I can.
to
Yeah, I'll just have a look because what I have got is put it into context. And if we put it into context, let's have a quick look at this. Yeah, I mean, I won't go through all of these because it's too many slides, but what we can have a look at just for the last few minutes is the fact that what does a big bath look like? Yeah, and I can show you this on one of my little slides that I've got actually because it's quite interesting. And let's just have a look. Yeah, so we've got yeah, so I'll bring this one up, then you can have a look at it. Yeah, let me just share the screen with you. Yeah, so if I have a look at this one for you, and let me share this one. So hopefully you can see that. So you can see if we're looking at a big bath.
Yes, we can see the screen.
This is a real life example of a big bath. So in case you think, well, what is a big bath? Well, it's probably a little bit small because I can't get the actual full screen up. But if you have a look at this red line here, Maybe I can just make my screen a little bit larger here. Let's just see if I can do that. If I make it a little bit larger, you might be able to see it a bit more. Let's see. So this is an example of a big bath, okay? And that's a little bit bigger, isn't it? So you can see here, and it's quite easy to detect, but what you've got, and this is from my actual data that I've got on my PhD, just for one company, but what you've got is you've got the earnings both before and after the big bath. That's the expected earnings. And then you've got the impact of the asset impairment charge. It brings the earnings down. And the characteristic of a big bath is often known to the fact that what you're looking at here is earnings might be down already. So the blue line looks like the earnings are coming down already. And then the effect of the asset impairment charge, well, that makes it come down even more. So it's almost like sort of news is already bad here. Yeah, this is already earnings coming down already, but the impact of writing off the asset impairment charge here makes it even bigger. And so that's the characteristic, if you like, of a big bath. And so that's a sort of a practical example in terms of saying, okay, what is a big bath? What does it mean? And this is what companies have actually reported upon. So it's when a company deliberately writes off a large amount when earnings are sort of perceived to be low anyway. And so that's quite an interesting phenomenon. And then you've got the other characteristic is that of income smoothing. And you can see this one again. You've got the sort of the actual earnings. So you've got the actual earnings are, as it says there, on the red line, so that they're up and down. They're up and down all the time here. Yeah, but by either carrying out an asset impairment charge or not carrying out an asset impairment charge, so income smoothing can go up or down. It can go one way or the other. And income smoothing can indeed either have the impact of making earnings higher than what they might be, or it can also bring earnings lower than what they might have been otherwise within expectations. So that's two different forms. So a big bath is bringing earnings right down, and often that's associated with a change of management, because if you think about a change of management, and in particular if they've got some sort of bonus when it comes to profits, for example, or return on assets. So if they have a big write-off in the year that they come in to the business, it means in future years it might make the company more profitable, and therefore it may well impact their bonuses. So, but yeah, I mean, you're quite right, Yuli, that this is looking at very large listed companies in the UK, of which we have quite a lot. So, if the business environment is more smaller companies in Colombia, it might not be such a big issue. But in general, any company that produces a set of published financial statements and that are in the public domain, well then, in general, what it means is that IAS 36, they have got some propensity, if you like, to maybe have some subjectivity as to whether they decide to write off an amount of some assets. So it doesn't matter whether they're tangible or intangible, but also they've got quite a lot of subjectivity in terms of how much do they write off. So that's the other issue. So there's quite a lot of subjectivity, whether it's a big company or not. But the other thing, remember what I mentioned at the very start, is this whole issue of agency theory. So this is the bigger picture, if you like, because with agency theory, the big assumption is that you've got separation of ownership and management of the company. So if you've got a small company that's owner managed, for example, in other words, the owner is the shareholder, then you're not going to have this agency problem, because there's no separation of ownership from the management of the company. So therefore, this whole idea of manipulation and trying to make the profit figure look better or worse than it really is, it doesn't come into play, because the managers are the shareholders, and there is no separation of ownership. So that the assumption is that the managers are the owners, and they are operating in the best interest of the company. So, that's why I mentioned at the very start is the agency theory aspect holds true. And you're quite right. When we apply this to some other countries, particularly companies that have countries that have more family-owned companies, well, then it doesn't become such an issue. So it only becomes more of an issue when we've got managers that are running the company on behalf of shareholders, and you have to ask yourself, well, what's the motive for that? But also it does become an issue in terms of the timing of results. So typically, if companies are going to publish their financial information, if it's available in the public domain, typically it must be going to the shareholders, and so it all depends who the shareholders are as to what the motivations are in terms of this behavior when it comes to big bath accounting or income smoothing. So I mean, that's sort of a bit of background there, and I mean, yeah.
Yes, thank you. Thank you for that explanation. I believe it will be of much value to the students. This is the first time that they do see those two terms, and it would be interesting for them to see your analysis on them.
Yes, well, that's right. I mean, if you do a quick search of the literature, there's quite a lot. And a big bath is a funny name to me. When I first heard the term big bath, I thought, what is this small bath, big bath? What does it mean? And of course, in English, it means it means literally, if you're going to take a big bath, it's like a big write-off, but it's not like taking a shower. It's a bath, so it means a big bath, a big write-off. So it's a bit what we call quirky. It's a quirky name in English.
Okay.
It's a bit odd. It's a bit odd, but it's what it means is a large write-off, and is this write-off really needed or not? That's the key question.
Okay, it makes sense.
Yeah.
Oh, now I understand, because I thought that big bath was because of the picture that it looks like a bath.
Well,
But
that's
now that
true
you
as well.
explain.
Yeah. Well, I mean, it does look like a bath, a bit. So I mean, you could
Yeah, exactly.
have a double thing there. Yeah, but
But I
the
believe
real
it's
thing
what you were saying.
is a
Shower.
big dip. Yeah, and it's a big bath. When I first saw the term big bath, I didn't like it. I thought, well, that's silly. Why are they calling it a big bath? But it's just to give it a bit more of an interest. That's what it's all about.
Yes,
It
makes
sounds
sense.
better than large write-off in English. It's supposed to catch people's attention.
Yes, it does. It makes
Yeah.
sense.
So, but anyway, so I mean, well, I hope you. Anyway, well, like I say, but there is I did send the full paper over, so it gives it a bit more detail. And also, of course, if you just look up in the literature, earnings management, income smoothing, big baths, you'll find quite a lot of information there. But I mean, I'm sure you can apply it in the Colombian context if you've got, you've got a stock market there, you've got some listed companies, but
Yes.
it does relate mainly to those companies that are producing published financial statements, and you can look at their financial statements and you can evaluate them and think, okay, do these statements look like they're showing a true and fair view, or do we think they've been a little bit manipulated? That's the real sort of crux of the matter. So if you can pick up a set of company accounts over a number of years, whether it's your electricity company or some other company, and have a look at them and say, well, yeah, what do we think to these accounts? And of course, the COVID pandemic's affected a lot of companies just recently. So clearly there might be some big losses going on for the current year. But if you go back even further, if you can do a 5-year analysis, you can see, well, what's the impact of COVID on company performance, for example. And so there's lots of interesting things you could do. So I mean, my research is all about evaluating and analyzing real life company reports. So that's what I enjoy doing. And every company tells a different story when it comes to these sorts of company reports. Yeah.
That's true. Well, thank you, Dr. Richard.
Well,
Dr.
thank you for
Andrews,
having
your
me.
intervention.
Yeah. Well, I hope it was useful, and I hope I didn't go too fast for everybody. But this is recorded, is it? I think you can probably listen back to it, maybe.
Yes, it is. It is recorded, and we will share this with our students of accounting. They're going to find it
Good.
very
Well,
valuable.
yeah. Well, I mean, you've got my email there, r.c.andrews@hull.ac.uk. So if you've got any questions at all, just feel free to email me. No problem at all.
Yes, thank you. Thank you for that. And thank you
That's
for
great.
accepting our invitation.
Well, it's been very nice. I wish I could have visited Colombia myself. It would have been very nice, but everything's virtual now, isn't it? But anyway, maybe one time.
Yes,
Yeah.
I hope
Okay.
to have you here.
Great. Yeah. Okay. Well, thanks very much for that. So I'll leave the session now then, shall I? Thank you.
Thank you.
We thank our guests for their special participation and all attendees for joining us in this session of Cátedra Europa. We invite you to continue supporting the education of talented students through our scholarship fundraising campaign Más Becas by clicking on the donations button on the homepage of Cátedra Europa. We also encourage you to stay connected to the rest of Cátedra Europa's events. Thank you and have a nice day.